Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Portfolio Evaluation. The section goal is to understand the portfolio strategies and evaluations, and the module goal is to understand measurement of portfolio evaluation. Let's talk about performance evaluation in portfolio management. Performance evaluations is used to test the notion of market efficiency. It is used for two key purposes. Backtest a prospective investment strategy and to test and report investment performance. Some of performance evaluation measures include mean variance measures, CAPM or beta measures, downside risk measures, and benchmark. Portfolio performance measures should be a key aspect of the investment decision process. These tools provide the necessary information for investors to assess how effectively their money has been invested. Let's begin with mean variance measures, the Sharpe ratio. Sharpe ratio indicates the excess return of the portfolio or assets per unit of total risk. The Sharpe ratio can be used to evaluate the total performance of an aggregate investment portfolio or the performance of an individual stock. The Sharpe ratio indicates how well an equity investment performs in comparison to the rate of return on risk-free investments, such as U.S. government treasury bonds or bills. The Sharpe ratio is one of the most widely used methods for measuring risk-adjusted relative returns. Next is Modigliani and Modigliani measures. The Modigliani measures, also known as M2 measures, is used to derive the risk-adjusted return of an investment. It shows the return on an investment adjusted for risk in comparison to a benchmark. It is shown as units of percentage returns. Equates the volatility of the managed portfolio with the market by creating a hypothetical portfolio made up of bank bills and managed portfolio. It provides a measure of differential return. The other measurement is Treynor ratio. In essence, the Treynor ratio is a risk-adjusted measurement of return based on systematic risk. The reward to volatility ratio is a performance metric for determining how much excess return was generated for each unit of risk taken on portfolio. While the investment is truly risk-free, the Treynor ratio typically uses treasury bills to represent a risk-free return. Risk is determined by the portfolio's beta, which is a measure of an investment portfolio's general systematic risk. Next, Jensen's measure. The Jensen's measure or Jensen's alpha is a risk-adjusted performance measure that represents the average return on a portfolio or investment, above or below that predicted by the capital asset pricing model, given the portfolio or investment's beta and average market return. This metric is also commonly referred to as simply alpha. So, Jensen's alpha is essentially excess return or actual realized return over the expected return. Next is information ratio. It considers the trade-off in active investment between alpha and idiosyncratic risk. It divides the alpha of the portfolio by the non-systematic risk. The information ratio is a measurement of portfolio returns beyond the returns of a benchmark, usually an index, compared to the volatility of those returns. The benchmark used is typically an index that represents the market or a particular sector or industry. The information ratio is often used as a measure of a portfolio manager's level of skills and ability to generate excess returns relative to a benchmark, but it also attempts to identify the consistency of the performance by incorporating a tracking error or standard deviation component into the calculation. So, which measure is appropriate? It depends on investment assumptions. If the portfolio represents the entire investment for an individual, Sharpe index compared to the Sharpe index for the market. If the portfolio is part of a larger portfolio, use the Jensen or the Treynor measure. The Treynor measure is more complete because it adjusts for risk. If the portfolio is an active portfolio to be mixed with an index portfolio, use the information ratio. And if you believe factors beyond mean variance explain returns, use downside risk measures as supplements. Let's have a quiz for this material. Suppose the risk-free return is 6%. The beta for a managed portfolio is 1.5, the alpha is 3%, and the average return is 18%. Based on Jensen's measure of portfolio performance, the return on the market portfolio is A. 10%, B. 12%, C. 15%, and D. 20%. So, this is the end for this module. See you!